How can you increase your borrowing power in 2022? In this video, we're going to give you practical tips and pointers on what you can do today to increase your borrowing capacity. We're not going to tell you about saving extra deposit. We're not going to tell you to go out and rip up credit cards, but we're going to give you actual examples and ways that you can increase how much you can borrow towards a home in 2022.
Now, you might have seen previous videos where we've talked about this exact thing, but this is updated to 2022 and there's been a bunch of changes. So let's start off with the first one, which is a new thing, and it's called debt to income ratio.
Late last year, APRA, the bank's regulators, got involved with the market and made the banks do a couple of things. They increased their servicing benchmark by 0.5% and implemented a debt to income ratio, which was never there. And in some cases, especially with smaller lenders, they're limiting your debt to income to 6 times. So what does this mean practically?
As Jaden said, your debt to income ratio is actually a new limitation on what you can borrow. Now, with some lenders limiting your debt to income ratio to no more than 6 times, this actually means it reduces your borrowing power quite significantly. And there are ways around this debt to income ratio.
Practically speaking, if you're on $70,000, your maximum borrowing capacity based on a 6 times DTI would be $420,000. And this is it. With some banks, especially the smaller ones, it's a hard cap. They will not give you $1 over $420,000. But if you run the numbers through a couple other banks' calculators, they'll end up to 7 times DTI, or in other words, your maximum borrowing capacity will increase from $420,000 to $490,000.
Now, this is only an example on a 70 grand income. When you've got 2 applicants with 2 incomes, this can be a huge difference between being able to borrow what you're after and not. Now, we are finding a lot more banks are being stricter with the debt to income ratio. The good news is there are ways around it. We've got some lenders that don't take debt to income ratio into consideration, which means that your borrowing power isn't affected.
Some banks will actually go up to 9 times debt to income, depending on other criteria. So if you do need help, if you've come up against a DTI wall, hit us up at huntergalloway.com.au. We'd love to help out.
The second thing affecting your borrowing power in 2022 is the product you choose.
Fixed rates are incredibly popular at the moment. According to recent statistics, over half of home buyers in 2022 have opted for a fixed rate. Everyone's been worried about interest rates going up, but it can actually make a massive impact to your borrowing capacity. Now, the reason being, on a fixed rate, the banks give a lower discount off their rate compared to the variable rates. For example, in a lot of cases, the banks will give you a 0.15 or a 0.2% discount on their fixed reference rate, compared to the variable rate where they might give you a 1 to 2% discount off their standard variable rate. This impacts how they assess your home loan application.
So put it simply, if you're getting a fixed rate, which is 2.5% today, and after the fixed rate ends in 2 years' time, the variable rate goes back up to 4%, the bank's actually completing their assessment on your 4% plus a buffer, which reduces your borrowing power.
Now, different banks have different ways of assessing this, but this is something to be really wary of because it can make a massive difference when you're looking at, say, an all variable loan with a 2% off the standard variable rate discount or an all fixed loan with a 0.15% discount. Practically speaking, in that earlier scenario where you might have a $70,000 income, if you fixed your whole loan, your maximum borrowing capacity could be limited to $450,000. Or if you looked at variable or a loan product like a basic rate that has a higher discount, your borrowing capacity actually goes to $490,000. So in some cases, if you're going for that $490,000 loan at the maximum of your borrowing capacity, you might have to settle on a basic or a variable product. Then after settlement, you can switch it around because they've already done their assessment, they don't really care at that point, and change to a fixed rate product.
Now, the good news is not all banks do this. So there are some lenders that do give you a post fixed rate discount off the variable rate in which your borrowing power won't be affected. Once again, talk to your mortgage broker. They can help you navigate through this and make sure you're making the right decision to maximize your borrowing ability.
The third thing that's making massive waves in your borrowing capacity in 2022 are your investment property expenses. Now, if you're an investor, we're not necessarily talking about first home buyers in this point, but when you own more than 2 investment properties, there are some lenders that are wanting to get your actual property expenses that you spent on your investment property in the last 12 months. They're going through your tax returns and getting every dollar you've spent on that investment property for rates, electricity, maintenance, everything else, working out that figure, it might be a few $1,000s a year, and taking it off the gross rent that they're calculating your borrowing capacity for.
The other thing that some other lenders are doing is they're not even looking at your expenses. They're taking a flat 25% of your gross rental income and saying that's your monthly expense ongoing for the maintenance of that property.
It can be quite a joke because they already sensitized the gross rental by 30%. So they're taking 70% figure, then they're taking another 25% off that. So they're pretty much using half of the rent you actually receive in the borrowing capacity calculator. This can make the difference of hundreds of thousands of dollars in your borrowing capacity if you're looking at buying an investment property. So again, check out with your broker, make sure they factor this in because it can mean the difference between growing your portfolio to shrinking it.
So another thing, reducing your borrowing power in 2022 is your HECS debt.
HECS is one of those things that you don't even notice. You go to uni, you leave uni, you start working, and every month a little bit comes out of your payslip. But fast forward to the end, if you're a lawyer, you might owe a bunch on HECS. You might owe 10,000, you might owe 100,000, you might owe 300,000. But the repayments are the same, it depends on your income. The banks calculate your repayments on your HECS not on how much you owe, but on the repayment thresholds according to the ATO website. And if you're earning, say, 100,000, they'll take a flat 7% off your income to work out your extra payments. So it doesn't matter if you owe $1 on HECS or $100,000, the banks, when they're calculating serviceability, will calculate 7% of your income to pay off HECS.
Yeah, this is where we've done scenarios with our own customers where we've gone, well, hey, look, you've got a $10,000 HECS debt. It's reducing your borrowing by $100,000. If you pay out your HECS, it's actually a good trade-off. So once again, something to run through with your mortgage broker because there can be a point in which it actually makes sense to close off your HECS. Even though that the interest you pay the government is a lot lower than what you pay on a home loan, it does immensely increase your borrowing abilities.
The next thing that does affect your borrowing capacity massively, and something that happens on almost every second application at the moment, is your credit card. Now, I said earlier in the video we weren't going to talk about this, but I'm going to be honest, it makes a huge difference because it's so easy just to rack up credit cards. You might get one for some Qantas frequent flyer points, you got another one where you got some Virgin flyer points, and at the end of the day, you might have $20,000, $30,000, $40,000 in credit cards that you're not using. And you might say, hey, Jaden, I'm not even using those credit cards. There's $0 owing. Why does the bank care that I've got a $10,000 credit card?
And that's because every $10,000 in credit limit you have, it reduces your borrowing power by about $70,000. So even if you're not using that credit card, you're paying it out each month, that does make a big impact on your ability to borrow. A lot of times we get customers to reduce their credit card limit or even close their credit card altogether because it does make such an important difference in what you can afford to borrow.
The crazy thing is, this is just done at the time of assessment. And a lot of people will talk to 6, 12 months after they've bought their home, say, oh, you know what's weird? I had to close my credit card from application, but then the bank called me a month after it offered me a $10,000, $20,000 credit limit. The reason for that is the way that they assess home loans is completely different to the way they assess credit cards. And in credit card lending, they're a bit looser. So just keep that in mind. For your application, you might need to close it, but then in the future, you can always review it.
And the last thing that's reducing your borrowing power in 2022 is living expenses.
So this is something that's just started happening in the last few months. The banks previously would just look at your living expenses and say, oh, it's all kind of discretionary. Nathan, if you spent a bit too much at Dan Murphy's, you had a bit too much fun at the weekend, we don't really mind. These days, they're looking into the expenses a little bit more. And they're looking into things like private health, school fees, and life insurance. And if you have any of these three things, they'll add them on top of their basic living expenses. It can make a pretty big difference if you're paying $200, $300 a month in private health or private school fees, obviously, because they're a lot more expensive than that. Again, as we've kind of mentioned a few times in this video, each bank assesses this differently. So if you're having issues with it, other banks might actually include it in your monthly living expenses and it won't impact your borrowing capacity. Get your broker to run through these figures because it can make a massive difference. There's also a few smaller banks that are a bit more conservative that will run off your actual living expenses. So be wary of this. Make sure your broker checks them before submitting your application because it can be the difference between buying a home and being way short. Are you looking at buying a home in 2022? At Hunter Galloway, we help home buyers across Australia. There's no fees for our services. We're paid by the lenders on success of finding and helping you with a home loan. If you need help with a home loan, if you need help with your borrowing capacity, or if you've got any questions, we'd love to help out. Hit us up at huntergalloway.com.au. Look at our Facebook group. You can check it out in the link below. And if you've got any questions, leave a comment. Till next time, guys. See you later.